It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital, and joining me today is the Mayor of Beckerville, Mr. Mayor Michael Becker.
Hey, Paul.
So, Michael, who owns, 5,200 units you guys have bought and sold?
Yeah, we've done over 5,200 apartment units. Yep.
That's a lot.
It's a lot of apartment units. Yep.
Yeah,
about 5 years or less.
That's almost like a suburb of Dallas, that you control an entire suburb.
Yeah. It's a lot of apartments.
And we're getting towards tax season right now. You guys have done over, 500 K1s from investors that have invested with you?
Yeah, 2017 was about 500 K1s.
I don't know how you guys stay on top of that stuff. Do you have like a software program or how?
We try to stay as organized as possible. We have a team and dedicated, and we just kind of just do them one by one and mark them off. And we just work real close with the accountant. And the easiest thing we do is we start with the deals that have the most K1s in them, and we start there, and then we work our way down. So that's kind of the process.
I see. Before we get into the question for Mike, a couple of things, just like housekeeping. Don't forget May the 2nd, Apartment Investor Network out in San Jose, California. Again, we are part of a sponsorship group. DoubleTree Inn, right next to the airport in San Jose, May 2nd. Go to the Old Capital podcast to sign up for that. We're going to have the top economist analyst from CoStar speaking, David Kahn. And he's going to go in a little bit more detail about why people who live in California should invest in Texas. So I've been banging the table about that for 10 years. And I was just out in Southern California last week, and a lot of money out there. So it's a good opportunity to invest in an area and diversify a little bit in other parts of the country. Also, don't forget about the conference, to sign up in the Old Capital Podcast Conference for September 13th at the AT&T Stadium. Get in the game. Get in the game is the conference. Roger Staubach is our keynote speaker. September 13th, that's an all-day conference. We are probably about half full of ticket sales. So we need for you to get signed up and get a ticket for that, because that's going to be, it's the premier event for us, and it's one of the premier events in the multifamily apartment industry throughout the nation. Anything more to add on that?
Yeah, no, it'd be great. We should have, last year we had about 450 people, and we were busting at the seams of the Addison Convention Center. So we're stepping it up this year, going to the AT&T Stadium. Expect to have over 700 people there. In my opinion, more than the content that you're going to learn, which I think will be very top-notch content. It's about networking. It's about getting out there, and that's one thing that we constantly beat the table on. It. This is not a business you can do behind your computer or behind your phone. You got to get out there. You got to meet people. You got to network. That's it. And we're going to have a lot of the top brokers from, all over the state will be in at a conference, and we'll have, a broker panel and, a bunch of networking opportunities. So get out there. If you're serious about this business, either being a passive or being a lead, this is a place where you want to be.
Jump in an airplane, Southwest airplane, get to Texas just for that one conference. So a question came up for Michael is, Michael, I'm helping a friend of mine kind of review a property in an area that I'm not too familiar with. What should I know about that?
Yeah, it's funny. So some of the things we do at my company, SPI Advisor, is, occasionally we'll help other people buy apartment complexes. We call it like advisory services. So recently we were helping one of our clients who was looking to buy a property, and it was in a part of town that we don't typically try to buy in. It's the east part of Fort Worth. And we kind of think that's historically a little bit higher crime area. And so we really started kind of getting into this, into a deal that I don't normally get into. And so some of the principles that we always preach on here,
What's rule number one?
Yeah, rule number one is don't buy in the hood. So this area wasn't quite exactly the hood, but it certainly had a little bit more elevated crime and a little lower socioeconomic area. So kind of getting into the deal, some of the things that kind of resonated with the principals, and we ultimately ended up not pursuing the deal with the client, was we got in the deal, and on the surface, the rental rates are strong. There was certainly some upside. The market rents at the property, the most recent leases were materially higher than what they were signing 10, 12 months ago, and the competitor properties were even a little bit higher. So we felt like there was some definitely room to push the rents. And on initial drive-by, just kind of the first thing I did, I just went I was going out to look at one of our other properties out west of there, so just drove through it and never got out of my car, and it looked pretty clean from the parking lot in my car going 10 miles an hour, I guess. And then we kind of come back and get a little more serious about it and start touring it. when you get out of the car and actually start walking through all the buildings and, kind of walking through the interior corridors of the buildings, you start noticing there was a lot more deferred maintenance on the deal than kind of what was initially visible just from the parking lot. And they did a pretty good job of keeping the front part of the property together, but you get towards the back, there's a lot of carpentry, wood rot and paint chipping. And so it looked like you had to spend, more money than what we initially thought on carpentry and, basically do a full exterior paint job. So that was one issue. And then two, we kind of get into the deal and really start drilling down into it. The initial underwriting had about a 90% economic occupancy, which is what we, historically can have in the types of properties that we own. So, you typically can underwrite to about 10% economic vacancy. We start kind of really drilling into it. And one of our buddies happens to own a deal right around the corner from the subject property that we're looking at. So we call a management company, we call the regional for that management company who we know pretty well and start talking on the phone. And, right around the corner there, he's giving us some feedback about how the rental rates are strong and, their physical occupancy is still pretty high. But their biggest problem is on the economic side. They have quite a few skips and evictions. So they're, have all this bad debt that they just can't come in and collect because these guys just kind of either can't pay and you got to go evict them, or they just kind of, in the middle of the night, they skip out of the place and they, leave your unit all torn up. So it's not only the lack of the bad debt when they don't collect it, it's also, higher admin fees by having to go to court and file evictions. So, we're underwriting normal admin fees, and he's like, you need to underwrite higher admin fees because of that. Then as well as the turnover cost was materially higher because these people are beating the crap out of these units as they're skipping or evicting out of there as well. So, we were underwriting kind of normal turnover costs, and you start plugging that in the model, then, everything starts looking worse and worse and worse. So we ultimately ended up not pursuing the deal, but it was kind of a good process to go through and kind of really kind of got me back to the principles of the business when we're going through this exercise that don't buy in the hood. When you go into tougher, higher crime, lower socioeconomic areas, you get things like more skips, more evictions. You have to underwrite higher admin costs, more bad debt, higher turnover costs. These are all things that you gotta pay attention to when you're looking at these lower socioeconomic areas.
I always go with the prudent man theory. Is that what was funny is that Michael knew the management company next door to this property, and then you got to ask, well, why doesn't that owner pursue this property? It's it's just right across the street, economies of scale. Just go over and buy this property. This is a kind of a small. It's a large market, but everybody knows that property was for sale. So how come this guy didn't walk across the street and say, hey, listen, I'll buy the property and operate more efficiently? So, that was a little bit of a tell that even the person in the neighborhood didn't want to pursue the deal.
Yeah, that's it. And the ultimately the group that bought it certainly has a reputation of buying a bunch of properties in tougher locations locally, and they're out of the area coming in, and they've been pretty aggressive in some pretty questionable locations, in my opinion. So that felt better that we ultimately didn't pursue the deal.
Rule number one: do not buy in the hood, please.
And it's been good for the last several years, and that area has certainly done well. And the owners that owned in that market have certainly made a bunch of money. But that music stops at some point.
And it will. I mean, Michael's a former banker for a large national bank. Like him, like we've been the angel of death coming in to say goodbye to some of these properties. And the music can't stop, so you just want to make sure that if you are saddled with this property during a period of time that the financial markets do stop, that you can continue to operate efficiently.
Yeah, because in this environment, kind of the feedback we're getting is they just can't crack 85% economic over around the corner from the property you're looking at. And then this environment, which is like the golden age of apartment ownership and everything's going well, and you can't crack 85 economic today, what's it going to look like in a tougher economic environment? And, the answer is you might be 70 economic. Who knows?
Not good. Not good. If someone wanted to find a little bit more about what you do, Michael, and the SPI team, what's the best information, the best way to get in contact with you? Yeah,
the easiest and best way is certainly just go to our company's website. My company's SPI Advisory, so just go to our website, which is www.spiadvisory.com, SPI like spy, advisory.com, and then there's a contact us page, and I'm always happy to set up a 10, 15-minute telephone call with listeners of the podcast if you guys want to get to know a little bit more about what we do.
That's great. And then also don't forget about the 17-page white paper report on multifamily financing 101. Gives you kind of the platform of how these transactions are put together on the oldcapitalpodcast.com website, Old Capital Podcast website. Also, too, don't forget we have some videos, brand new videos that have come out with our physical engineer, Brian Amos, who kind of goes through maybe a 4 or 5 minute video about what you should be looking for when you do go under a contract or an LOI on a property. I can't think of a better guy to kind of help you, be an advocate for you, and he kind of shares some information about what you should be looking for. It's a great video. Anything else, Michael?
That's it. We certainly look forward to seeing everyone out. I think we're working on setting the final date, but the second week of May, probably the Wednesday or Thursday, the second week of May, we're going to have the next Old Capital speaker series. So that'll be coming up. Go to oldcapitalpodcast.com again. You can find information about that as soon as we announce it. And we'll hopefully get that locked down in the next week or so.
All right. That's Michael Becker, Mayor of Beckerville. I'm Paul Peebles. Have a great day.